Here we're doing our stock of the day forecast here, and I wanted to put JP Morgan back up on the board here because it's a tendency for the market to eventually forget of an issue that one of them has. After a while, it starts to recover. Everybody gets excited, and they forget the fact that it really had a bad time of it. And of course, the banks, a lot of times lead the market. They really are leaders of the marketplace. So it's important to pay attention to what's going on with the banks here. And you can see it's had a very long decline here. We just did a very simple 50% retracement here. But what you see here is it starts to try to come back into it. You have several issues that are coming up in here, and as you start to see this rebound, you start to say, okay, I have to have a realistic understanding that this isn't just going to new highs here. I mean, if you have that expectation, you're really misguided. Okay, because that's not what happens here a lot of times with these kind of stocks, especially with these bad news. You could see you have a gap down here, dramatic move. You could see sideways action, really did a very strong move. You could see a very clear 1, 2, 3, 4, 5 wave count. And right here, because you're not seeing this big impulsive move, that it's a 1, 2, 3 corrective move. And where is it stepping into? It's stepping into the 50% retracement range. It's stepping into a 50-day moving average. You have a 100-day moving average just slightly over 40. So as it starts to move into the 37 range, why would you anticipate to get more here? Now, what's interesting is people would say, well, it's not a perfect 50% retracement, so why wouldn't I know that, and why is it stopping there? Well, here's a perfect example here of a lot of times people don't realize they're not looking at the correct history here, and history does repeat itself. Here is the correct retracement on the move, because what is more significant, this last move or the longer term move? Here is your initial impulse move on the move it had. This is a very important corrective move that it had, and you're seeing this rally back. So what you're seeing is the action off of this retracement. So it's important to put 2 of the retracements in there, and then it even makes more sense of why you're seeing the price action start to really break. Look at when it hit this 50% retracement. Look at the big move it had. It didn't even go any further from that move. So not only do you have 2 retracements that are very, very close, within about $1.50 of each other, but you have a 50-day moving average. You have it near a 100-day moving average. You also have it, here's a gap here. You know that the gap's